I think the reality is sometimes you can learn from what we have, and sometimes you learn from what we do not. And what might be more interesting are the names that we didn't cut. So this reflects an earnings season that was the absolute worst fundamental earnings season in a very long time. Gross margin, EBIT, all the worst in years. What's interesting about it? The stocks have come to reflect that.
Right.
And I think there's actually some opportunities. I know this is supposed to be a very negative segment, and there are plenty of cuts there. There are also this barbell of names that are not.
The ones you cut, though, and
Yeah.
by the way, this is not supposed to be a negative segment. We're just going with what you did,
Yeah.
okay? How much of this is attributable, though, to the tariffs, the higher cost that that's bringing them, squeezing their margins, or if they can't pass it on to their customers, which theoretically is only temporary here?
So the interesting part of this is that this is a structural challenge that retail's been facing for years. And I think that 2018 was a little bit of a head fake. So the first list of companies that you just mentioned that we went through, the common denominator, they're in the mall. And no one's going to be surprised to hear that the mall is challenged. And I think that what was interesting was that there was this optical head fake in terms of inventory being clean last year that made all these others look a lot more attractive than perhaps they really were. So when I think about the tariffs, when I think about wage, my team and I just put out a big report on wages yesterday. When I think about promotions and regular inventory, because the consumer just demands deals, retailers are facing a challenging moment because they've been facing a challenging moment. And I think that's going to persist.
You have three companies at least that you think can weather this, though: Nike, Amazon, and TJX, the parent company of TJ Maxx. Why those three?
So the way we're viewing this is let's barbell. Let's take some consistent, strong outperformers. And the reality is the companies that you just listed, so that would be the left side of my barbell, are these large companies that are going to be able to get through, companies that generally benefit from dislocation, companies that generally benefit from their size. So TJ, from an off-price perspective, let the inventories inflate across the rest of the world. TJ is where people are going to go. Amazon obviously taking that share. I think that will continue. And then Nike, the reality is the checks that they write for their athletes make it very hard for others to compete. On the flip side, so if we want to get a little bit more in the weeds and willing to take a little bit more risk, I think these multinational brands are priced a little bit too far. We're going back to that priced for death mentality. So
right.
Tapestry, Capri, even Ralph Lauren and PVH. Whereas I think there's a lot of complacency in the U.S.
Nike, they have a big exposure to China, though, don't they?
They do. Well, to your point, so the question is it temporary? I think that the reality is if tariffs are allowed to last for multiple years on a prolonged basis, the entire sector is in a lot of trouble because I don't think that the consumer is going to be willing to take that price.
We're back on, I mean, you mentioned last year being a head fake very quickly. 2 years ago, record number of store closures.
Yeah.
We're on pace to do that again this year, aren't we?
Yes. I think that if you and I were starting a company, I don't think that we want it for it to be a retailer. I think we want it for it to be a brand within this world. You want to have control and you want to know where you can sell. And as long as you have that marketing dollar to push there, Nike can get a lot of people to buy a lot of shirts and shoes.